Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend, Brent Moores, who is a 20-plus year veteran of the financial markets and nobody that I'd want backing me up more here on the chat. So glad to have Brent out here helping out today. Remember to ask him the questions that you got, and we'll try to incorporate those questions into the discussion along the way. Now, if you're watching this in the recorded version, we're glad that you're here as well. Make sure that you leave your comments in the comment section. That's going to help us out and allow us to know what you're thinking about, allow us to comment. And that does a couple of things. One, that allows you to get an answer. Two, it allows us to get some engagement going and bring this content up to the top of the algorithm, as does subscribing and clicking on the like button, all of those great things, which we'll talk about as we get into this discussion. Now, as we start to talk today about long verticals and diagonals, I had the opportunity to teach this webcast last Thursday, as well as the short vertical spreads webcast right after that. And so we did a little bit of comparison. We looked at long vertical spreads directly compared to their analog of a short vertical spread and how that worked out directionally. So we've got a couple of evaluations that we want to look at, and then I've got a couple of examples that we might take a look at given the current market scenario. Plus, we had that zebra that's been grazing away in its pasture, so we'll talk about that trade example as well. But a couple of quick housekeeping items as we get into this. Remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks. Standardize options before considering any option transaction. Multiple leg option transactions or multiple leg option strategies will involve multiple transaction costs, and spread trading generally must be done in a margin account. We're going to use the Thinkorswim desktop software platform. It's a great learning environment, specifically the paper money version. Not a guarantee of future success out there in the real world, but it's a great place to practice. It's a good sandbox to learn in. Remember that anytime you're short an American style option, there's the potential that that option could be assigned early. Depends on the circumstances, how likely that is to happen, which we'll talk about as we get into this discussion. Now, remember that investing involves risk, including loss of principal. Past performance of any security strategy does not guarantee future results or success. We also may talk about some short-term option transactions and strategies in this discussion today. Remember that those short-term option strategies, as you get closer to expiration, may entail some additional risks, including risk of market movement, the potential that the broker could either take the trade off or not initiate the trade in the event of a potential for adverse movement. So we'll talk about that as we get into this discussion as well in this discussion today. But I wanted to do this really quickly as we get into this. So I want to talk kind of just in a general agenda. We're going to talk about long vertical and diagonal strategies. We're going to discuss the impact, as we always do, of price, time, and volatility. Those are the, for everybody calling themselves the usual suspect, which I love. Price, time, and volatility are the usual suspects of what impact option price movement. And we'll look at that and see how that works in terms of some example and illustrative trades here into this discussion. And Brent will be there to help answer some of those questions. So what I'm going to do really quickly is I'm going to pop over here to the Thinkorswim desktop software platform. Good opportunity for me to once again remind you to click on the subscribe button down there at the bottom of the page. It's at no cost to you. For those of you who aren't familiar with YouTube, and I know that there are some of you out there, I know most of you are, veterans of watching YouTube videos, but if you're not, one of the reasons why that subscribe button is so important is because it helps you out to be able to find the content. It also helps other people out. So if you want to take a little bit of an altruistic approach and help other traders out in finding this content, the more you subscribe, the more of you that subscribe to this content, the more views we get in this content, and then the better able we are to promote and provide this great content. So it's a nice symbiotic relationship. Click on that subscribe button, click on the like button if you haven't done so already. We'd love to have that connection with you and that engagement. So taking a look at what's going on with the SPX today. We talked a little bit about this yesterday, and I just wanted to get into this just briefly because I don't want to necessarily belabor this, but we have kind of a toggle point and a little bit of a shift from where we were a week ago when we talked about long vertical spreads in this discussion. We were still a little bit bullish last week. We took some bullish trade examples and kind of ran with those. But here we are now a week later, and we see kind of this toggle point above the 200 period moving average. And that's occurred both on the NASDAQ and the SPX, the S&P 500 that we're looking at here. Both of those RSI indicators are either in or up near the RSI, that kind of overbought range. That suggests that there's some momentum moving higher. And we're seeing maybe a little bit of a pause here, kind of this sideways movement. Nevertheless, this is still a couple of things going on here. One, a break above a resistance level, a break above the 200 period moving average, and it's doing it with some momentum. So there's a lot to be bullish in this perspective from a technical analysis lens. There are a lot of bullish indications. Does that mean that the market can't reverse? Absolutely means that there is that possibility, but there's still that bullish trend going on here, right? Taking a look at the NASDAQ, same kind of thing, and we see maybe a little bit more bullishness today in this individual candle as the RSI is above that overbought line. A little bit of a gap down, but a rally in today's movement. Now, some earnings news and some diminished guidance, that's kind of weighing perhaps, and there's a little bit of wait and see to see some economic data as we get through this week and into next week, but the market still seeing some pretty substantial bullishness in this particular case, simply from a technical analysis perspective. And the Russell 2000, the small caps, I talked a little bit about this yesterday. I talked a little bit about this on Tuesday in my futures class, that this is kind of staying in this neutral range here, kind of in the gap area. RSI kind of backing off a little bit of neutral movement as we start to see rates moving around again and ahead of. I mean, we're now a week past the Fed meeting, the last Fed meeting, with some new stuff in the language going into next month's Fed meeting, where there is an expectation potentially of a rate cut, and that expectation kind of moderating just a little bit. And that may be what's holding the Russell 2000 in stasis here at the moment. So one other thing I wanted to look at, and that is the VIX. And the reason that I wanted to bring the VIX into this discussion is because in addition to direction, right? So remember, price, time, and volatility, those are our usual suspects of what impact option prices. So we talked about price movement, right? Directional movement in the market as a whole, got our sense of our market posture. Now taking a look at volatility, we can see that volatility has kind of been back down into this 17 range. It's currently sitting at about 1841. We saw a bit of a move higher, and then it's falling off just a little bit today. Again, consistent with price movement, but volatility still kind of staying down here around these lows in this area, still well below its 30-period average, but volatility still low. If we start to see the market pull back just a little bit directionally, it's likely that the VIX may move higher, right? So there was, and Brent remembers this, there used to be this phrase that we would oftentimes repeat, and it was, when the VIX is low, it's time to go. And when the VIX is high, it's time to buy. And I don't like that phrase at all. I think it's diminutive in terms of the nuances of the VIX. But when we say, look, the VIX is low, that suggests that when the VIX is low, it has the potential to move higher. And when the VIX is high, it has the potential to move lower. And we've seen that happen. What would cause the VIX to move higher from a low position would be the market moving lower generally, and buyers buying protective strategies and protective options. So that might not be such a great thing. It doesn't happen necessarily that way. And it's not kind of that relationship. It doesn't mean because the VIX is low, we got to sell everything, right? That's not the way that it looks, and not the way and that was the problem with that phrase. But it just reminds us that VIX is a mean reverting structure. When it's very low, it tends to go higher. When it's very high, it tends to go lower. So long vertical spreads tend to benefit from tend to benefit from upward movement in implied volatility. So direction, implied volatility low, and potentially moving higher, both of those are working in favor of long vertical spreads. So that's kind of setting the stage here, if you will. So what I want to do first is I want to jump into the trade idea based on those aspects, and then I want to come back and I want to monitor some of those positions. So let's get into the new stuff first, and I'm going to come back over here and we're going to pop to our single grid. And in that single grid, the one that I'm going to bring up here is McDonald's, MCD, and not because, you know, they make a tasty breakfast sandwich or a McRib or, you know, something like that, or, you know, we're now well past Shamrock Shake season. But what I've noticed here in McDonald's is this little bit of a bounce up off of the support level. And I saw this today. It came up as, I mean, this is in one of my watch lists. I was scanning through the watch list, and I noticed two circumstances in this particular case that really kind of caught my attention in terms of a long vertical spread perspective. The one was the low implied volatility, right? It's down near its lower portion of the range, and that's because it's past earnings. It's kind of been moving sideways. It's not a very volatile stock to begin with. But the second circumstance that kind of caught my eye in this sense was the bounce off of that support level, right? So again, you know, we've talked a lot and we've got a lot of webcasts that discuss this idea of, you know, what are you looking for, or what are traders looking for on a bounce up off of support from a directional movement perspective? And whether that's a close above the high of the low day, well, we don't have that yet. We have a trade above the high of the low day. Depending on where you draw your line here, you either use this as the low day, that hammer candle, or you use this big kind of dragonfly doji as the low day. Technically, this dragonfly doji candle right here is the low day, and it touched that 304 support. Now we're getting a trade up above that high, and in fact, almost above the midpoint. If you think about that, that midpoint of that big green candle today is just about where that dragonfly doji occurs, right? So fly away, little dragonfly. See this upward movement making this move to the upside. So in long vertical spreads, generally, right? Long vertical spreads, the idea is to buy where the price of the stock is currently, and then sell where we think the price might be going to, right? That's just a starting point. That's a consideration. It's not a hard and fast rule. It's just a thought, right? So if the price is currently at around 315, and we think that the price is going to go to this next level of resistance that it's run into now once, twice, three times a resistance up here, there's that potential for a little bit of upside movement. And it may take a little while. Although, you know, this tends, if we go back in time and we look at how long it takes to transit this range that it's been in, depending on how far that range is, we can say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. We can say, look, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days. So anywhere from 10 to 15 days, right? That this typically takes to transit from bottom to top of this range. Well, here we are coming off of the bottom of the range. Here's the top of the potential range. We could even extend this out a little bit further out to that 325 mark. That's what we're going to use implied volatility for, is to help us to understand the likely potential movement. When implied volatility is low, that suggests that the stock is likely to be less volatile, because you remember that volatility is a measure of expected movement, or at least implied volatility is expected movement. So when volatility is low, that says there's a lower expected movement in the price of the stock. So that's kind of the thought process, right? So let's put this trade together. Now, speaking of that, the thought process here, I happen to notice out there in the chat, there is a feedback survey. Our thought process in providing you with that feedback survey is so that you can help us, and by in turn, we can help you because if you fill out that feedback survey and you let us know what you think, we read every one of those comments, and that helps us to make these sessions better for you. So click on that feedback survey, set it aside if you want to, and then come back to it, or click on it and fill it out right now, or click and fill it out by the end of the webcast. Whatever you do, just do that. Click on it and fill it out, and we appreciate that. That helps us out and it helps you out. So let's build this trade off this 315, 320 expectation. And with the understanding that we're looking at about a 15 to 20 day move time frame. So price, time, and volatility. We kind of have that expectation. Again, those usual suspects coming home to roost here. So let's go to the trade tab for McDonald's. And I happen to have from another webcast, I've got an iron condor on McDonald's, kind of looking at bracketing that range. That's on a shorter term time frame. But I'm going to come out here and I'm going to give it a little bit more time. One of the things that we talk about, and especially if you go to Connie Hill's long options webcast, where she talks about long directional options, and a long vertical spread is simply an extension of that, is buying a little bit more time than you think it might take for the trade to go to its expected move. And so one of the things that we might think about is going out in time far enough that we've got enough time that we can sell some of that time back to somebody else. Now, there's a balance here, because in a long vertical spread, the driver is the long leg, the offset to the driver is the short leg. The long leg is going to benefit from implied volatility, but it's going rising, but it's going to suffer from the passage of time. But the hope is that the short leg is going to suffer faster. So there's a balance here. There's always a balance. So we're going to go out to the 6th June expiration, and that's 22 days to go until expiration. And if we come over to the right-hand side and we see that our expected move in that time frame, in that 22-day time frame, is about 12 points. We're expecting at least 5 points of move. And realistically, we're buying more time than we think we might need. So what I'm also going to do is I'm going to say, hey, I'm going to check a shorter time frame and see if that's consistent. The expected move within that shorter time frame is consistent with what my directional expectation is. So remember, I'm expecting a 5-point move. That's how we're putting the trade together. So I'm going to come down to this shorter time frame, anywhere between 8 and 15 days to go. And my expected move, given implied volatility, is between $7 and $10, roughly, just rounding those numbers. So that is well within the range of reaching that 5-point upward move. Now, remember, this could also move down that same amount. And this isn't a hard and fast rule either. This is simply what implied volatility is suggesting might happen. It doesn't guarantee it by any means. And this is theoretical. So let's do this. We're going to open up the 6th June expiration, and I'm going to come down here to my 315 call strike. Directionally, we're bullish. Implied volatility is low, and I'm expecting a 5-point move to the upside. So the price of the stock's currently sitting right about if we look at the at-the-money strike, the closest mathematical strike is this 315 strike. And I'm going to change my layout here to Delta, Theta, and Vega. Those are the 3 big ones that I'm going to pay attention to here. So notice that 315 being my at-the-money strike and has the greatest amount of extrinsic value. My spread between the bid and the ask is fairly narrow, 5 by 525 ask. And so that tells me that there's probably some pretty good liquidity here in this particular case. So here's what I'm going to do. I'm going to look at buying the 315 and we're going to sell the 320. It's going to be a $5 wide spread, and we're going to do that, and let's see what we get for that spread, or what we're paying for that spread. So I'm going to buy the 315. I'm going to hold my control key down, and I'm going to sell the 320. And I can see that that 320 bid-ask spread is fairly tight as well. So now I'm getting a $5 wide spread for less than $2.25 in this case, so a little bit less than half the width of the spread. So that's okay. I'm good with that in this scenario. If I click on confirm and send, my max gain is the width of the spread minus my premium that I'm paying. My max loss is the premium that I'm paying. That's also my buying power impact on this particular trade. So the expectation, however, in this particular case is what do we expect this trade to do for us? So what I'm going to do, and Frankie, hopefully this will kind of answer part of this question. What I'm going to do, Frankie had asked a question about delta and the Greeks earlier. What I'm going to do is I'm going to change this layout here from spread being single to spread being a vertical. And by default, if I did that vertical, it's going to be a one strike wide spread. So there's my 320, 325 spread, and I'm buying it. I'm sorry, 315, 320. That's the one that we were looking at buying. And so there's my cost to buy the spread. Here's my price to sell the spread. But what this leaves me with in this view, which is kind of cool, if you do the layout this way, is it leaves me with the net Greeks for the spread. So this is an option spread that has 16 cents of directional delta, meaning it's sensitive to that directional movement, bullishly, not nearly as much as the long strike it was by itself, right? The 315 strike had about a 52 or 53 cent delta. So we've diminished that because we created it as a spread, but it is still bullishly sensitive. But here's the other thing. Look at our theta, right? So our theta basically becomes almost zero. I mean, it's a little bit. We're losing a penny a day. So if this makes a quick move, that's great, right? And if implied volatility goes up, our net implied volatility sensitivity, or our net vega, is positive, meaning if implied volatility goes up, cool, that's working in our favor, right? So as we put this trade together, these are the three influences that we're going to pay attention to as we build this this spread, right? 16 cent positive delta. Theta is eating away at our premium by to the tune of about a penny a day. And that's the other thing to think about too here is because remember that 320 strike is going to move from being out of the money to being more in the money, which means that its theta is going to increase as it gets more to the at the money strike, which means that it's going to be working on the short leg faster than the longer leg. Because look at what happens here. And this is, I think, an interesting point. And now we're getting a little bit deeper into the context of time decay here, but I wanted to change this layout back to single once again. Notice how theta slides off as the leg gets deeper into the money, right? Theta peaks at the money strike. So if the 315 strike moves a little deeper into the money, if the price of the stock moves, that theta is going to go down on the long leg. But theta is going to increase because here we are at the 320. Theta is going to increase on the short leg because the short leg is going to move closer to the at the money position. Does that make sense? Because we get this shift as we get to that at the money strike. We get that shift as this moves towards directionally where we're expecting it to go. So it's actually kind of rotating that time decay sensitivity into a more positive position for us as the buyer of the spread. And again, that's one of the reasons why a long vertical spread now oftentimes requires some patience, because if you don't get the directional move, or you get the directional move late, it takes a while because you've got a very small amount of time decay. It takes a while for that time decay, that small theta number on the combined spread, to eat away at that option premium. Now, realistically, that's part of the scenario, right? A long vertical spread does require some patience to get to its max theoretical gain. So it's got to be something that you pay attention to, right? Tom Petty said the waiting is the hardest part. So you got to keep that in mind. Now, Tiago asks this question: can you change the width of the spread to put it in that combined or that layout? Yeah, watch this. Click on spread, come down here to deep and wide, and we could go, all right, 1 month, 2 strike wide vertical spread, or 3 strike wide vertical spread, or 4 strike wide vertical spread. Let's make a 2 strike wide vertical spread. And now we're talking about the 315, 325 vertical spread. And you see what happens now. Now that directional sensitivity is increased, but it's got to move further in order to get to that expectation. Plus, it's going to cost us more to buy it. It's going to cost us more to buy it, right? All right, so let's take this back to our single legs, all the single legs, all the single legs. All right, sorry. There you go. My shout out to all the single ladies. Now, okay, so taking a look at this spread, we're going to confirm and send. We're going to read through this. And before we send this order off, I'm just going to do one thing real quick. I'm going to right click and we're going to send this to the Analyze tab. I'm going to take a couple of these other positions that I've got off on McDonald's here, and we'll see what this looks like from that Analyze tab perspective. I'm going to set this to my expiration, which is the 6th of June. So this is the range that the stock is expected to be in based on implied volatility. And we're going to set our strike or set our slice to break even. And so the price of the stock's got to be above 317.32 for us to break even on the trade. Right now, the stock's right about the 315 mark. So it's got to make that little bit of a move to get there. So, again, long vertical spread is a directional trade. So it's an expectation of price movement, right? Now, let's put this trade on, and then I want to look at one other possible iteration of this trade. So I'm going to do this. I'm going to go to confirm and send. I'm going to put this in our vertical spreads group where we've had other examples. Read through the order, make sure that we're aware of it, make sure that we're aware of any alerts that pop up here. We're going to send that spread off. Now, in terms of legging into the trade, meaning we buy the long leg, let it move, and then we sell the short leg, means that we're buying a relatively expensive long option to begin with. Josh was the one who asked the question, and then we're offsetting it. And if the price is moving directionally, then guess what's happening to our short leg that we're looking at selling? It's getting less expensive. So you can certainly do that. It may benefit to put the trade on as a whole, depending on what your expectation is. Not a problem legging into it, but you may have to look and then see what your directional expectation is, and then if you're bringing in enough premium in that case to offset and make turning it into a spread worthwhile, right? It increases the probability of success, but it decreases the profitability of the trade, and that's always the trade-off, right? So now that we've got that scenario here, let's go back to the trade tab. And we put that one on, but let's take a look at another scenario here. And that might be, well, wait a second, McDonald's is making a big move today. And it could transit that range here. What if we were to do this? Let's go to the trade tab and let's go to the May 16th, which is tomorrow. We're 1 day away from expiration. Now, I'm just going to say this. This is not a zero DTE trade. This is a trade that begins today and ends tomorrow. 2 days technically in this trade, right? So what if we were to put together a shorter term spread here, smaller expected move, and see how that worked for us, right? And see if that might be directionally a trade that might make sense. In fact, what we could do is we could make this a maybe a little more highly probable trade, but let's see if it makes sense from a directional movement standpoint. So we could go to the 312 half, right? A little bit deeper in the money. 70-cent delta, so stronger directionally. If we were to buy the 312 half and we were to sell the 315, right? Where the stock almost is now. We're not expecting as much directional movement. This is going to be a little bit higher cost trade, still $2.50 wide, and we're paying $1.40 for it. But take a look at this, confirm and send. Now our max theoretical profit is $1.05 against $1.45. Almost still that one to one, not quite, a little bit diminished from 1 to 1, but higher probability because the stock's already almost at that point and it's above its break even already. And this is a shorter term time frame. So could you create a long vertical spread in this particular case? Yeah, let's see what our net Greeks look like though, really quickly in this particular trade. So I'm going to pop this back down. We're going to change our spread once again to vertical spread so that we see that one strike wide. And here's our 312 and a half, our 312 half and 315 vertical spread. So notice something here. Long directionally, it's got a higher delta, so it's more directionally sensitive, even than the one that we went further out in time with, which is to be expected because it's a little bit deeper in the money. Theta is working in our against us here, to the tune of really working. Actually, the challenge is here in this case. I'm not really all that worried about theta because I know that all of that time value is going to go away between now and tomorrow, and end of the option lifespan tomorrow. Volatility, I don't care what volatility does because it has a very low sensitivity to volatility. So I don't care if volatility goes up or down, but putting this trade on now puts this kind of to work in our favor because that's going to work on that short leg really fast. And it's going to work on the long leg not quite as fast. So in fact, in this particular case, we're putting theta to work in our favor in a long vertical spread. Wait, how do we do that? Well, it's because we've got a short time frame. And again, remember, theta increases as we get closer to expiration, but we've now sold the option at the money position. This is what I was talking about with that previous long vertical spread, that it may rotate to as it gets closer to the price that we'd expected it to move to. We're just concatenating the time frame, right? We're truncating the length of time that we expect to be in this trade. We're looking at over 2 days. So this, however, requires, and I'm just going to say this requires more attention. As Stephen Sondheim says in Assassins, attention must be paid in this particular case because this could move against you pretty quickly. Again, because as we get closer to expiration, the price of the stock could roll one side or one direction or the other. There's not a lot of time to recover in this particular trade. But again, that goes back to the concept behind a long vertical spread. We're going to position size for maximum theoretical gain and simply assume, hey, this trade is either going to go out in our favor or it's going to go out against us. If we're assigned early, which is a possibility here in this particular case, because it's a call option, we're at the money, we're close to expiration, max theoretical gain. And that's okay, because in that particular case, that is the goal. We want both of these options to end up in the money at expiration. And that's the scenario that would result theoretically in maximum gain. So shorter term, and this is something that you can practice in your paper money account. Remember that paper money does not facilitate the early assignment of short options, so you're not going to see that circumstance occur. But this is something that I would encourage practice before considering trading a strategy like this in live trading, simply because you then become familiar with how that moves. And it's already moving. Look where the price of the stock is. It's already put this trade basically an in the money position. Almost, right? So we're getting closer to that, but we're well above that. We're well above the break-even point on this particular trade. Again, not a recommendation, simply an illustrative example. And what we're going to do is we're going to click on confirm and send, read through this order, make sure that we're aware of it. And as I've been talking, this is diminished in terms of its profitability, simply because the price of the stock has moved a little bit higher already. And the more it moves, the lower the profitability in this trade, theoretical profitability in the trade, because the more it's going to cost. So I'm going to click on send and I'm going to stop talking and we're going to send that order off, and we ended up buying that order. And we'll see how that works as we come back and take a look at this trade next week. Now, speaking of taking a look at a couple of trades, I've got a couple that I wanted to look at really quick. We're going to go to the monitor tab. We're going to look in our vertical spread section. The first one I wanted to look at in this particular case was this Delta Airlines comparison. And in Delta, in this case, we've got 15 days and 29 days to go until expiration. So we had a short call, a short put vertical that was bullish, and we had a long call vertical that was bullish, both bullish expectations. But I wanted you to notice the circumstances here. One, the short put vertical, that short put vertical in this case, bullish expectation, we brought in 83 cents. It's now trading for 26 cents. So we're profitable in this particular trade. We could close this trade down now and realize about 2/3 of what we could theoretically make in the trade. That's great. The long vertical spread We bought it for $1.52, and we can sell it now. It's bouncing kind of around right about the $2 mark. So if we were to look at the percentage return here on this, what we could make from it, so let's just call it, I'm going to round it to $2, divided by what we paid for it, which was $1.52. If we could sell it for $2 right now, that's about 131% return, right? That, I think, in this scenario, right, gives us that possibility of taking this trade-off, right? And the closer we get to expiration, likely, if the price keeps moving, this is going to become more expensive. So once again, the waiting is the hardest part in these comparisons. The last trade I wanted to look at here really quickly was this one. This is our Carnival Cruise. This is our Zebra trade. And you remember the Zebra trade was this. We bought 2 calls, we sold 1 call. And we did it in a way that basically made extrinsic value a wash. So we kind of washed out the impact of time decay. We washed out the impact of changes in implied volatility. It simply becomes a directional trade that has 30%. Sorry, you're right, Frankie. Thanks. Again, my math. I mean, 130% seems like excessive, right? 30%. Thank you, guys. This is why I need you guys as part of this, right? Let's go to the Analyze tab and let's take a look at this trade really quickly on CCL. CCL. And you can see where we are right now. So we bought 2 of the 16 strike, 6 June long calls. And we sold 1 of the 22 strike, June 6th call options. And that created this pattern in our Analyze tab in our risk profile graph, which means the reason we bought 2 and sold 1 is we wanted to still have that long call there to provide that upward movement. Look, if we right-click on this, we right-click and we say confirm and send, this still has infinite potential upside, right? It has that undefined limit on the upside because you're ending up with a long call, even if the long call vertical gets exercised and assigned early, right? You still have that long call with that potential upside movement. The long call vertical is capped at a maximum gain, but here we are right now. Price of the stock's at 25.17. We're well up that slope. We've got 8 days to go until expiration. Now what's going to happen is this may be the point in time where we look at closing this trade down, simply because if we look at the chart for Delta or for Carnival, kind of running into that resistance level. If this starts to move against us, here's what may happen. I want to go back to the Analyze tab and I want to talk through this. This is a characteristic of a Zebra trade. If we look at this line being our 0 line, right, between profit and loss, this angle right here is smaller than this angle right here. Not by much, but it is. So what this means is this gains value slower than it loses value. If we start to see price move in this direction, this is going to start to accelerate down towards that maximum theoretical loss quickly. So we're going to look at taking this trade off. We only have 8 days to go. So if this starts to move down against us, there's not a lot of time for this to recover. So I'm going to look at taking this trade off simply because I don't want to get into that position in this scenario where the price of this option accelerates to the downside more than it was moving to the upside. Nice that it makes that move to the upside and it's doing what we expected it to do, but if it goes against us, it can go against us really fast in this particular case. So I'm going to come back over here to the monitor tab. We're going to right click and we're going to close this trade down. Now, sometimes in closing a Zebra trade, we've got to do this in 2 components because we've got to do this. We've got to sell the vertical spread, and then we've got to sell the long option. Here's the thing that I oftentimes will like to do, and that is just simply for the standpoint of avoiding an inadvertent situation if the order doesn't fill in its entirety, is buy back the short leg, because that's what creates the obligation. So buy back the short option first and then sell the 2 long options. So I'm going to do that. I'm going to buy back, and this is oftentimes how we close out this this type of trade, the zebra trade, is buy back the short first. So I'm going to fire that order off. I'm going to click on confirm and send. We're going to send it there, reading through the order, make sure that's what I want to do. Because now, once that's bought back, the obligation is gone. I'm left with 2 long calls. 2 long calls, the risk is still simply, in this case, what we paid for them. Now I'm going to go back to the monitor tab. I've left with those 2 long calls. I'm going to right click. I'm going to create a closing order, and I'm going to sell those 2 back. And we're going to fire this order off and make sure that that's what we wanted to do. Now we've sold it. So selling it in 2 parts, creating this or closing this zebra trade in 2 parts, eliminates, and doing it the way that we did it, eliminates the possibility that we could end up with an inadvertent naked position. So that's kind of the thought process in putting that trade together. So if you want to learn more about these trades and these ideas, great way to do this is to come over to, let's see, I think I had it right here. Let's go right here. Trader Talks webcast page, type right here. If you want to learn more about zebras, Z-E-B-R-A, zebra, right there. Type in zebra. So zeroing out extrinsic with zebra spreads, replacing stock with the zebra. Here's Brent talking about zebras in the Advanced Option Strategies webcast. And we talk a lot about those types of expectations in building these trades and managing these trades. So this is a great way to do that. If you come over here, if you haven't done so already, make sure you click on the subscribe link. And once again, as we jump into this discussion and finish this up, my thanks to Brent Morris for helping out. My thanks to our great production staff, and I thank all of you for being here. Remember to click on that feedback survey, fill that out, help us out, let us know what you think, and have a great day, everybody. Take care. Bye-bye.